Welcome to Talk Tickers. Today, we're doing a deep dive into the Century Communities, Inc. second quarter 2025 earnings call. And for you, the experienced investor listening in, our goal is, well, it's to cut through all that noise, right? Get you the really critical insights, the key takeaways, so you're informed without drowning in the details.
Exactly. And diving straight in Century Communities' Q2 performance, it showed some impressive navigation. It's a challenging market out there, no doubt, but they met expectations. Deliveries were 2,587 homes. That's actually a notable 13% jump sequentially.
13%. Wow.
Yeah, and it beat their own guidance, which was 2,300 to 2,500 homes. So pretty solid. This translated into home sales revenue hitting $976 million. That's a 10% sequential uplift.
Okay. Strong revenue number.
It is. Now, their average sales price, the ASP, that stood at $378,000. That was down 3% year over year.
Ah, okay. Why was that?
Mostly higher incentive. They'd offer more to keep things moving.
Right. Okay. So despite those higher incentives, they managed more deliveries, boosted revenue significantly, a strong top line. But is that coming at a cost? What's the bottom line telling us about, profitability and efficiency here?
That's the crucial question, isn't it? So net income was reported at $35 million. That works out to $1.14 per diluted share. Their adjusted net income, that came in a bit higher at $42 million, or 1.37 per diluted share.
Okay. And margins?
Yeah. Adjusted home building gross margin was 20%. That is down from 21.6% in Q1, which, like you said, reflects those incentives.
Makes sense.
But on the other hand, their SG&A costs, selling, general, administrative, they kept those pretty disciplined. 13.2% of home sales revenue, same as before. Mm-hmm. And a key takeaway on financial health, really robust. They ended the quarter with $858 million in liquidity, strong position.
And that's a good cushion.
And their book value per share hit a new company record, $86.39. That's up 10% year over year.
Wow, a record book value, up 10% year on year. That's definitely strong. But, if the market isn't quite seeing that in the share price, what do you think is driving that disconnect?
It's a common theme right now, isn't it?
Yeah.
Often just broad sector sentiment weighing things down.
Right. And moving beyond the financials, we know the market's been tough. How are things like mortgage rates and just general consumer caution actually playing out day to day for Century?
Well, management definitely highlighted that. Order activity, it's still feeling the impact of those higher rates, affordability constraints, just general economic uncertainty, and cautious consumers. But they did see sequential improvement in net orders and absorption rates in May and June. So some positive movement.
Okay, but with a catch.
Yeah, the caveat is that overall Q2 absorptions were still below what you typically expect seasonally. And looking ahead, they mentioned July absorption rates are actually trending below Q2 levels. So still a cautious environment.
It sounds like a bit of a mixed bag then. Some improvement, but not back to normal yet. Given that caution, you might expect more buyers to, get cold feet. What about cancellations?
That's actually a really interesting point. Cancellation rates have stayed remarkably stable, and they're significantly below the pre-COVID averages, which were, often in the 20-25% range.
Really? That is notable.
It suggests that the buyers who are in the market now are pretty committed, maybe more driven by necessity, long-term plans, not just speculation. It's kind of a powerful signal about underlying demand, even with the headwinds.
So committed buyers, but they still need coaxing, right? Back to the incentives.
Exactly. That's the main lever they're pulling. Incentives jumped to about 1,500 basis points in Q2. That's way up from roughly 900 basis points in Q1.
Big jump.
Huge. And they're projecting maybe another up to 100 basis points increase in Q3. They see that as the main thing driving near-term gross margin changes.
Okay, pretty clear signal there. Market still needs those deals. But if they're giving ground on price, how are they managing things internally? Costs, operations? Are they offsetting that pressure somewhere else?
Yeah, and this is where their operational strengths really come into play. They've been very successful controlling direct construction costs. Those actually declined 3% year over year and 2% sequentially on the homes they delivered.
That's impressive cost control.
It is. And they expect costs might come down even further. Because housing starts have slowed industry-wide, they have more negotiating power with suppliers, with trades,
Right. Makes sense. Supply and demand.
Exactly. Now, finished lot costs were flat quarter over quarter. Management expects some land inflation eventually, but they think those direct cost reductions will help offset it, at least partially. It's a constant balancing act.
Okay, so getting more efficient on construction, keeping costs down, that's great. How does that connect with growth strategy? Like land, community count. They hit a record number of communities, right?
They did. And cycle times are improving too, another operational win. Averaging about 4 months now construction-wise. Some homes even built in like 70 to 90 days.
Wow, that's fast.
Super fast. They also said immigration reform hasn't impacted their labor base, which is good for keeping builds consistent. And importantly, they're disciplined with spec homes. Matching starts, which were 2,485 in Q2, pretty closely with sales, keeps inventory lean.
Smart. Prevents getting stuck with too much inventory. But in this tricky land market, how disciplined are they with new land? I thought I heard something about them walking away from some deals.
Yes, exactly. They ended Q2 with that record 327 communities. But, and this is important, most of that growth happened late in the quarter, like in June.
So it didn't really boost Q2 orders much.
Right, the new communities weren't open long enough. Looking ahead, they expect year-end community count to be up mid-single digits year over year.
Yeah.
That builds on the pretty impressive 28% growth they had in 2024. But yeah, back to that discipline. They actually decreased controlled lots by 12,000 sequentially. Took about $2.6 million in charges from exiting deals that just didn't make sense anymore.
So they're actively pruning.
Actively pruning. It really shows they can renegotiate, push out takedowns, get better prices. That's a direct benefit of their land light model. They use mostly traditional options, not rigid land banking. Gives them way more flexibility.
That land light approach sounds like it's really paying dividends, letting them be nimble. Okay, turning to capital allocation then. Strong balance sheet, you said. What are they doing with it? Sending cash back to shareholders?
They are indeed. Q2, they repurchased $48 million of their own stock. That's about 3% of outstanding shares. Year to date, that brings the total to $104 million. That's 5% of the shares they started the year with.
That's significant buyback activity.
It is. And since the start of 2024, they've bought back over 8% of their shares. Plus, they kept the quarterly cash dividend going at 0.29 cents per share.
So buybacks and dividends?
Yep. And their financial health backs it up. Low net debt to capital ratio, 31%, lots of liquidity, plus no senior debt due until June 2027. Plenty of flexibility there. It's a very solid position.
That is a pretty aggressive capital return, especially the buybacks. Signals real management confidence, doesn't it? Shifting gears slightly, how did their financial services arm do? That's often a good read on buyer activity.
Yeah, financial services had revenue of $23.8 million, pre-tax income of $6.2 million in Q2. The results got a boost, though. There was a $4 million gain from selling mortgage servicing rights, MSRs, on about $3 billion worth of loans.
A one-off gain?
Right. They expect the contribution margin from financial services in the second half of the year to look more like Q1, so more normalized without that gain.
Okay. So given all these pieces, the market, the operations, capital returns, what's their updated outlook, the guidance for the full year, and maybe Q3 specifically?
Right. So based on how things look now, they've revised full year 2025 guidance. Home deliveries. 10,000 to 10,500 homes.
Okay.
And home sales revenues. $3.8 billion to $4 billion. For Q3 specifically, they're looking at deliveries between 2,300 and 2,500 homes. That factors in the usual seasonal slowdown in absorption you see in July and August.
Got it. And margins for Q3?
They expect Q3 gross margin to ease a bit, maybe up to 100 basis points sequentially. Again, mainly due to those higher incentives. Full year SG&A should be around 13% of revenue, maybe a touch higher in Q3, like 14%.
And taxes, any change there?
Yeah, the full year tax rate is expected to be 26%. That's up a bit from 24.1% last year, mainly because fewer homes are qualifying for those 45L energy efficiency tax credits. So a minor headwind there.
Okay, helpful context. Let's talk geography. I mean, conditions vary so much across the U.S. Where are they seeing strength and where are things maybe tougher?
Good question. The West, overall, held up strong, though they noted some recent slowing in California specifically. The mountain region, kind of a mixed bag. Vegas started strong, slowed a bit, but still robust. Colorado's dealing more with affordability issues.
And Texas, always a big market.
Texas, yeah. Dallas was called out as particularly challenged. Houston and San Antonio are, navigating affordability and supply. But Century seems to be holding margins steady there.
Okay. Any standout regions?
The Southeast, definitely highlighted as their strongest overall market right now. Places like Atlanta, Charlotte, Nashville driving that. And another point they made, the Century Complete brand. That's their more affordable offering, less direct competition. It's done exceptionally well in places like the Carolinas, the Midwest. Shows targeting that affordable segment is really working.
Interesting. Good to hear about the Southeast and that century complete angle. What about other trends? Mortgages, for instance. Are buyers adapting to these higher rates?
Well, they said about 70% of their loans are government-backed, 30% conventional. But the really critical trend they flagged was increased buyer acceptance of ARM's adjustable rate mortgages.
ARMs are making a comeback.
Seems like it, yeah. Since late Q1, early Q2, it's a big sign. Buyers are adapting, looking for ways to, make the math work, bridge that affordability gap. It's just a kind of pragmatic approach creeping in.
That is a fascinating shift. Okay, couple of quick final points. Anything on potential lumber tariffs from Canada? And do they give data to the Census Bureau?
On lumber, yeah, they noted about 20-30% of their lumber comes from Canada. So they're watching those potential incremental tariffs closely. It's a risk to input costs for sure. And as for the census data, nope. They clarified they don't provide specific inventory data to the Census Bureau.
Got it.
So look, what does this all really boil down to for you? I think Century Communities is showing real resilience here. They're adapting strategically, not just reacting passively to this tough environment. And if you zoom out, strategically, their discipline on land, the aggressive cost control, the focus on capital return with those big buybacks, especially buying below book value, that positions them quite uniquely, I think.
Yeah, it suggests management really believes in the underlying value, right?
Yeah.
Despite the macro noise.
Exactly. Strong conviction. And that ARM trend, the buyer acceptance, that's critical to watch too, shows adaptability on the financing side, helping with affordability, which, it raises a big question. How effectively can builders like Century, ones with strong balance sheets, flexible operations, how well can they keep generating shareholder value if rates stay high and the economy's uncertain for a while? Managing incentives while keeping costs tight, that's going to be absolutely key.
That question you just raised about builders creating value, even in this environment, that leads us perfectly into, let's call it a thought experiment, something maybe a little outrageous but plausible for you, the astute investor, to mull over. This is our not financial advice segment.
Precisely. So given Century's discipline, especially buying back so much stock well below book value, like 37% below its record book value, here's the idea. Initiating a long position in Century Communities.
Okay, long a home builder right now. That definitely feels like the outrageous part. What's the plausible angle?
Right. The plausible part is this isn't just a simple bet on a housing rebound. It's more nuanced. It's a bet on, management's execution, which has been consistent. Their proven ability to manage costs, that shift towards ARMs, showing flexibility, and just the raw value proposition, shares trading way below book.
And the buybacks kind of backstop it.
Exactly. The buybacks act like a floor, signal that internal confidence. The market might just be over-discounting the stock because the whole sector's under pressure. So for an aggressive investor, maybe, just maybe, consider out-of-the-money call options. Perhaps targeting a strike 15-20% above current levels, maybe 6-9 months out.
Getting on a re-rating.
Betting on a re-rating as these strengths become clear, even if the macro picture only improves moderately. It's basically a conviction value play, finding potential value where others might just see sector risk.
Okay, an interesting thought experiment there. So wrapping this up, what does it all mean for you, the listener? Century Communities, they're really showing a compelling story here. Resilience, discipline, smart capital moves despite the headwinds. They're clearly focused on that balance between sales, pace, and price, growing communities thoughtfully, and using that land-light strategy to build value over the long haul. We've seen how they're, adapting to what buyers need now and staying profitable. Now, remember, everything we've discussed today pulled from the Century Communities Q2 2025 earnings call. It's purely for informational purposes. It is definitely not financial advice. Any investment decisions you make should absolutely be based on your own detailed research and talking with a qualified financial professional. But we do encourage you to think about those strategic points, disciplined capital allocation, operational efficiency, especially when markets get challenging. And hey, we love hearing from you. Reach out, let us know what stood out to you from this deep dive or any other topics you'd like us to tackle. Thanks for tuning in to Talk Tickers.